I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. I love having insurance entrepreneurs on the show, explaining their ideas and outlining the ambition they have for their business. It's a great way to discover the best opportunities that are out there in the marketplace. And when the guests are highly experienced with great track records, it just means that we should pay even more attention to what they're seeing. That's why I'm delighted that Michael Price, CEO, and Kean Driscoll, President and CEO of Dellwood Insurance Group, were able to spare time out of their busy schedules to appear on the Voice of Insurance. If you had the chance, how would you go about attacking the best business opportunities in the insurance industry today? For Michael and Kean, it's all about exploiting the increased flow of business that is finding its way into the US excess and surplus lines market. The advent of improved technology means that lots of small commercial insurance and even some personal lines are now able to take advantage of the more dynamic, responsive and entrepreneurial underwriting environment to be found outside admitted lines. Michael and Kean are applying the lessons learned from full careers in insurance and reinsurance to serving areas of high demand in the largest insurance market in the world. Dellwood is a startup working at a fascinating time, where insurance distribution is being remoulded, and new technologies such as AI are really beginning to come into their own. Just as dislocation and large shifts in demand are being experienced in many segments of the market in both property and casualty. Building a brand new player with no financial, technological, or indeed cultural legacy at a time like this looks like a very exciting move, allowing Dellwood to move fast to fill in the gaps and allow capital access to hopefully sustainably profitable pools of risk. Michael and Kean are laser focused on the job in hand, and this podcast is full to the brim of their wisdom and expertise as they look to capitalise on a career business opportunity and build a new premium insurance franchise. If you ever wanted to climb inside the minds of top insurers, thinkers and practitioners in full flight, this is your chance. Enjoy the podcast. Michael and Kean, welcome to the Voice of Insurance.
Thanks, Mark. It's really good to be here.
Yeah, thank you, Mark.
You're both pretty well known in the industry, but this being a global industry with a global audience here, listen to this podcast. For anyone who doesn't know you, why don't you just briefly introduce yourselves and run a little bit through your insurance careers to date, and then tell us how you got where you are today. Michael, why don't you start?
Sure. So my first 18 years of my career were exclusively in management and professional liability. Also have a pretty strong background in casualty. My career has always been on the primary insurance side with companies like Chubb, AIG, Hartford, and Arch. I actually entered the insurance industry, though, as an IT and operations professional in the early 1990s. And through my career, always put an emphasis on improving systems, data, and workflow. This operational work actually helped expand my underwriting career as I took on business transformations across property, casualty, specialty, even leisure travel insurance. So that's really a bit about my background.
The wonderful thing about insurance is that everyone falls into it in different ways, but I think that's the first career path I've ever heard that started with systems and IT. That's absolutely amazing. I mean, that's going to stand you in good stead as you're building a new company from scratch. That's pretty good. And Kean?
Yeah, Mark, I've been in the business for about 30 years. The predominance of that time was on the reinsurance side. A large proportion of that was with Validus Reinsurance. I was a day one employee there, watched the growth of that company over about a 13, 14-year period, expansion into Lloyd's through acquisition of syndicates, expansion into the U.S. excess and surplus lines market through acquisitions, into the crop sector, and into organic build out of ILS. I transitioned into the insurance business or the carrier side after the acquisition of Validus by AIG, where I had the opportunity to work with Michael for about 5 years. And now we're here today.
So we're right up to date. Tell us about Dellwood. What gave you the idea and what's the kind of eureka moment, the light bulb going on?
I think really just an extension of our backgrounds to a degree. Michael and I, given his primary background, focus on casualty professional, his broker connectivity, my background in reinsurance, capital markets, really more of a first party property focus. We always felt like 1 + 1 was 3 when we worked together. So when that opportunity arose, we really looked at the E&S market and the explosive growth over the last 5 years, $50 billion to $140 billion, against the backdrop of climate change, coupled with rising loss costs and casualty, whether it's social inflation, litigation finance. Our expectation is we will continue to see growth into the wholesale channel. It's more of a structural change than a cyclical change, and that's our belief. And in particular, the view is that the SME market is underserved for a variety of reasons, legacy technology deficits or lack of focus on building SME specific solutions. So the belief in Dellwood is really a wholesale only focus in the E&S market. Wholesalers in general offer an incredible value proposition in terms of access to markets, product knowledge, and data analytics. We felt like we could bring capacity, product knowledge, a variety of products into that market with a purist focus in an underserved growing segment. So this laser focus in a very sizable market where we're focusing on driving inefficiency out of the underwriting process, but not sacrificing underwriting standards is really what we're looking to do in terms of building a moat around the business.
And that focus on SMEs really interesting. Is that one of the things you want to be known for, to be a specialist in bringing that SME market, which I presume, let's say 30 years ago, SMEs weren't really going to be accessing the E&S market because our insurance industry was probably not efficient enough to be able to service them well from that angle, right?
Yeah, that's right. I mean, when you think about the growth in the E&S market, 50 billion back in 2018, that initial phase was a lot of large account business flipping from admitted paper to E&S paper. But a lot of that still was with the traditionally bulge bracket retailers. What's really been the underpinning has been the pervasiveness of the loss cost inflation in property and casualty all the way down to small business, just including even over 100 single state mutual insurance companies going belly up in the last couple of years. That's driving more and more small business into the channel. So while the wholesalers provide a tremendous value proposition to us in terms of operational leverage, as Kean mentioned, we hope that our ability to respond rapidly with great technology and great people gives us an equal proposition to them in terms of helping them solve the problem of this flood of new business coming into the market. So technology and efficiency are key ingredients, but the secret sauce really is people. To use a quote from one of my mentors, people are your greatest asset in an insurance company, and they take the elevator down every night and can choose whether to come back tomorrow. So equally as important for us was attracting the best underwriting talent and creating a culture of collaboration and enablement through an integrated model. We've been really fortunate to attract some great talent, and so great people enabled by great technology is an incredible value proposition, we think, for the wholesale channel. It's also a value proposition in us continuing to attract talent by eliminating the life-sucking work that goes into the underwriting process if we are able to achieve the success we think we can.
Kean, it was really interesting you to say that you think this move from admitted lines into E&S is a secular, i.e. a permanent change. And do you think, to analyze the reason why, is it because the business like SME is going to move? Because obviously those big accounts that you mentioned, those sort of, the big broker accounts, they often do flip and flop a little bit, don't they? They ebb and flow as the market ebbs and flows, so the appetites of the admitted lines market ebbs and flows. But with this, the component of that permanent change, is it the fact that SME business is now accessing the excess and surplus lines where it hadn't done before?
I think it's across the space. It's not just SME. You look at the dynamic in the marketplace, 50 state regulators, many of them are political elected positions. The ability to keep up with underlying rates against a backdrop of the shifting sand of underlying loss costs that are changing for a host of different reasons. It's hard to keep up in terms of pace on underlying costs. And I think that's the primary reason where we're seeing business come over the transom. And there's reason that business that moves into the E&S space shifts over. Sometimes it's rate, sometimes it's capacity, sometimes it's the complexity of the risk. And we feel like we're positioning ourselves to respond effectively. And SMEs is really responding in a similar way to what we're seeing now in even the homeowners market, where more business is flowing into the space. So I would have never expected that 10, 15, 20 years ago, but we're seeing lines of business that historically will stalwarts or classic admitted products moving into the wholesale channel, into the E&S space. So we feel really confident that that trend will continue. And you're right, we will see business even within those segments move back and forth, but on the whole, we think the momentum favors that dynamic.
So in terms of the identity of Dellwood, what you want to create in the mind of that broker who's thinking, who should I place this business with? What do you want them to think when they think Dellwood? Do you want them to think of SME? But it sounds like the opportunity is more across the board. Is that what you're going to be building? What do you want to be known for? What do you want to build specifically? And is there anything you don't want to do?
We're trying to build a great franchise. And as a new entrant with a smaller capital base, we feel that the value proposition is most pronounced with great people, tailoring coverage as needed, appropriate for the risk, enabled by great technology, but focused on this smaller business segment. That's really where we'll be laser focused for the time being. But, as you kind of heard from our backgrounds, Kean and I have global perspectives across many lines of business. And as the business matures, we can and should be able to expand and offer even more solutions to our wholesale brokers.
So it's going to be broader, and there's no specific red lines in terms of say, hey, we'd never do, marine aviation transport or that kind of thing.
Yeah, I think a lot of those things early on, as you get into some of those larger classes like aviation, it is more of a capacity play. It does probably introduce access to the London market at some point, but those are not in sort of our initial focus, just given the fact we want to do some things really, really well and really execute flawlessly in the areas within our initial mandate. We do think of ourselves as cycle managers. We watch the insurance market across every aspect of specialty and P&C. And when the time is right for us, we'll investigate those opportunities. But for the time being, it's really building a really great E&S company focused predominantly on the United States and focused predominantly on where the need is most pronounced, which is in property and casualty.
And in terms of that distribution, when I think of SME business, I almost assume that there will be delegated underwriting authority involved in writing that, or maybe not. You tell me. And so what sort of percentage of MGA, MGU business would you be backing your own MGUs? And sometimes you have in-house MGUs or teams of MGUs and MGAs that you're backing 100%. Anyway, just your thoughts on distribution there, because I suppose when I think of SME, obviously you talk about a high volume, low premium business. It doesn't sound like the sort of business you're going to have an underwriter sitting in a Dellwood office underwriting individually.
Yeah, so maybe just start with one of our anchor lines of business, which is contract binding operations. Contract binding, you're working through wholesalers, but you're actually working with general agency subsidiaries of a wholesale broker. And they're focused predominantly on what I would refer to as non-admitted BOP insurance. That business is highly efficient in that those wholesale general agents are underwriters. They access our systems, our rates, and they underwrite, quote, bind and issue in our system. And that's the starting point. We've then built our brokerage property and brokerage casualty teams to sit right above them, because we're also seeing as the contract binding market reaches its limits, there still is a wealth of small business in the brokerage channel that's equally as challenged. And so positioning our brokerage teams just right above our contract binding team to address the growing need in smaller accounts there. But back to delegated authority, Kean, I don't know if you want to kick off on programs. It's sort of how we think about the program segment.
Yeah, the MGA market obviously has gone through a tremendous amount of change over the last few years. It's in the US, a $70 billion market. It's been a draw for talent. It's been a draw for innovation. We're very interested in that space. That said, when we look at programs and we look at MGA business, we have really two critical thresholds. One, is there a unique underwriting or distribution advantage that we would not otherwise look to organically build out in terms of staffing or technology in order to enter that segment? Second, we want to ensure it doesn't cannibalize the other lines of business that we're entering into. So contract bind, property casualty, management liability, healthcare. And then if we can meet those two thresholds or get comfortable with those two thresholds in terms of a potential partner, we focus on profitability. And obviously that's a critical threshold item for us. We have one goal really organizationally, and that's to produce consistent and sustainable profitability. There are a lot of really talented underwriters that are out there that have invested in technology, that have built scale, that have unique distribution relationships and underwriting insight, and we're very happy to partner with that. In terms of what that will make up as a percentage of our overall portfolio, I mean, to Michael's point, with respect to cycle management, we're not pre-committing to a particular size in the portfolio, but given the ability to access larger portfolios and achieve scale through programs, we would expect initially it could represent a larger percentage of our overall portfolio in the first couple of years. But as we scale up the individual underwriting in the brokerage space and the contract bind space, we'd expect it to be somewhere in the order of 20% of our portfolio.
Yes, and obviously you only go into backing something if you think it's going to be profitable for all the parties and good for customers ultimately as well. And it sounds like you're agnostic about what that size might be, but in the long term, it might be an optimal size might be about 20% of the portfolio, you're saying.
Yeah. Again, not committing to a particular size of the portfolio, but if we were to project out, that seems like a reasonable percentage.
And in terms of the build out of the business, obviously you're middle of work in progress, aren't you? I mean, how far are you down your line in kind of your plan that you've had when you're sitting planning for maybe 5 years? How far along are you in executing in terms of the amount of hires and the infrastructure that you've built?
So we're kind of right where we thought we would be. When we were investigating the opportunity, and Kean and I really are students of the business, what companies have been successful, which ones have been a little bit more struggling out of the gate. For us, it really was trying to mitigate a lot of that execution risk early on. So we put a big emphasis on making sure we secured a great shell company. It's actually one of the secret assets we have. We were able to acquire a shell company that never issued a policy, never had an employee, never appointed an agent. So truly a clean shell. We took possession of that on June 3rd of last year and then capitalized the company. We're licensed in all 50 states. So we've been through sort of the regulatory burden. We've hired the initial team. We're about 60 people today, and we're really focused on building out the systems. So our contract binding system is live. Agents can quote, bind, and issue property and casualty in our contract binding system. During the course of 2025, we'll continue to populate more product in there. The next up is equipment breakdown to support the property writings, and then eventually some excess casualty that sits over the top of the general liability. Our property systems are really well along. We can ingest statements of values. We use some AI to scrub the SOVs, push it into our rating models, and then back to the underwriter in minutes. It used to take days. So our cycle times now for quoting small property business in the brokerage segment is now under 30-minute cycle times. And I think we're starting to get some eyebrows raised in the wholesale channel. Wow, that was quick. Our casualty systems are up and running. We're still working through the cobwebs in those, but they're moving pretty. And as Kean just briefly mentioned, we are going to launch a small professional liability and healthcare business in the second half of 2025. And those systems are now underway. So where we are in the build out is really pouring the foundation of the house. That's just about complete. We're framing the house out now and looking forward to the next phase where we start to put the finished carpentry in, which is really the fun stuff.
That's really interesting about the AI. It's also so rare to get a clean shell company with no liabilities. And also you've got no tech legacy either. So you've got no insurance legacy and no tech legacy. And you've mentioned about using AI to scrub submissions in property for ingestion. That seems to be everyone's favorite use case that I've spoken to over the last year since we really started talking about AI a lot. Any other use cases that you're kind of excited about throughout the value chain? Because obviously it goes all the way through to claims and everywhere else.
Yeah, so I think the view here is when we think about our architectural design for our systems, it's very important to us that we own the user experience. So we own the code. We've built it ourselves for how we interface with brokers and how our underwriters interface with our systems. We have a good policy administration system, and then we've built from day one a highly structured data warehouse so that all the data, both claims and underwriting at a very, very detailed level, resides in our warehouse. When you think about the journey of utilizing technology to enhance productivity and enhance underwriting, it's a multi-year journey. Day one, the use cases really are in the administrative functions. Getting through submission clearance and SOV scrubbing, that takes man hours away. And if the machine can learn and learn quickly, that adds incredible operational leverage. Over time, as our data matures, we'll be able to use machine learning to help with the analytics. But I do want to really emphasize that it's not going to replace underwriting talent. From our perspective, all of this great technology out there, the best use cases I see are to continue to make a more efficient organization on the one hand and improve information to put in the hands of great talent to make better decisions. And that flywheel of improvement will continue. You mentioned claims too. And again, that's another area. We do partner with a very, very strong TPA on the claims side that gives us operational bandwidth to support our in-house claims team. So again, there we have access to their data, their analytics. We will over time incorporate more in the way of fraud detection and other things into that. But this is a multi-year journey. From our perspective, day one is building that strong foundation, having good data running through your pipes, and then the use cases from there will continue to present themselves.
That's always really gratifying. It's nice to know that humans will still be okay. We'll all still be talking in 10 years' time, one hopes. I won't be talking to an AI. I don't know about you, but I think people want to buy insurance off other people, don't they? I mean, risk managers want to buy through a broker to an underwriter they might actually, go and have lunch with one day.
Absolutely view technology as an enabler of relationships, not a disintermediation. In many ways, things like AI or machine learning or just designing a really efficient end-to-end operating system addresses one of the biggest complaints in the market. There's too much rekeying of data because data doesn't flow efficiently from broker to underwriter or within an underwriting system on an end-to-end basis. By virtue of having a greenfield technology stack where we can really focus on removing those inefficiencies, it actually helps us perpetuate one of our integral goals, which is trying to attract exceptional talent. So we're building a home for underwriters that allows them to do just that, which is underwrite.
These days, I think, yes, it's going to become the new standard, isn't it? If you're onboarded in a new company and they're not investing in AI to ingest things, you'd say, well, maybe I made the wrong choice, wouldn't you? But certainly if you were a younger underwriter, you'd be saying, goodness me, I'm having second thoughts already. And in terms of, say, even on that ingestion, what's your kind of view of the increase in productivity that you get? And also, can you measure an increase in hit rate? Because it's certainly a factor. If you can get back quickly to that broker, you have a higher chance of getting a firm order.
No question. The more quotes that we can get out, the more efficiency we can drive in terms of queue management for the underwriters. You extrapolate that with a higher bind ratio over the course of a year, it has a material impact on our top line. But it also, I think, as importantly, given that we're focused on underwriting profitability, it gives the underwriter more time to actually consider the risk, to think critically about it, and to identify opportunities where they're going to deploy risk capital. So we think it works both in top line and in bottom line.
I can maybe even just visualize an example for you if you'd like. 12 years ago, 13 years ago, one of those business transformations I talked about earlier was in an E&S property division. At that point in time, submissions were cleared, printed, put in a manila folder, and the underwriter would typically wait and to see if the broker called and asked, hey, I really need you on this one. So even prioritization was really reactive to the broker need. When they called and said, we need you, at that point, you would take that submission, send it off to Manila or to India for modeling and scrubbing. You get it back 2 days later, and then you price your account. Along the way, too, on the service side of the business, endorsements are coming in, SOV changes are coming in, they're piling up in a queue, and sometimes booked out of sequence, and all of that operational work had to be addressed. You fast forward to where we are here at Dellwood today, that work happens instantaneously. So the submission comes in, the SOV is scrubbed instantaneously, modeled instantaneously, comes into the underwriter's queue. So now they can prioritize where they want to play. So again, that idea is it's not just operational efficiency, although that's a big part of it. It also then helps underwriters prioritize their queues to go and attack the best business as effectively as they can, which again goes back to Kean's point about it improves bottom line as well.
That's fantastic. No, and I suppose that allows the underwriter to be so much more strategic as well, to say, this is really an appetite. This is what I know I need to be doing. So I'm going to get on and do that. Or this is a broker I particularly want to be friends with. So I'm going to answer that one first. That's really fascinating. And then I suppose you can get more and more sophisticated, and can start helping with that triaging of that queue for the underwriter as well, using their own appetites and your own appetites to say, well, we know we're likely to get an order if we get back quickly on that one. It's also fully in our appetite to say, right, let's just get on it now. It's fascinating the way that productivity, but also, that efficacy, I suppose, of what we're all doing, making sure we're doing the things that we strategically want to do and that are going to give us success. It's even better. Do more of the things that are going to make you more money and make you and Kean happy.
Going back to my comment I made earlier, that's why we view technology as an enabler of relationships. It opens up that opportunity for our underwriters to engage with their distribution partners, provide solutions, and do it much more efficiently and effectively.
When you get that analytics, you can start to see patterns and think, well, there's probably demand here. There's demand that's not being met and all sorts of interesting things, all the nuances within the product and the coverage and other things. Let's talk about the market. You were quite bullish at the beginning when you talked about that flow into the E&S markets. It sounded like it was holding up pretty well. I mean, obviously, it's hard to generalize, but it's overall the market, the rate is tempering a little bit. It's softening a little bit. It's difficult to say, obviously, it's not softening everywhere across the board. How's that deal flow? Some of the first symptoms of a softening market is that the flow itself starts to slow down.
Well, I think on the flow side, we're not seeing that. Kean maybe will address rates, especially on property in a minute, but just in terms of demand into the channel, the major wholesale brokers are all forecasting 20% submission growth in 2025. So their swings at the plate are still there. On the rate side, Kean, I don't know if you want to take the property one because that's your home game.
We look at property and it's coming off of a multi-decadal high in terms of pricing. So no question pricing is crested and we are seeing some rate pressure, but we're still comfortable deploying capital and believe margins remain very attractive. Specifically, what we see in the SME space is there's probably less rate sensitivity. Really where some of the more acute rate pressure is on these larger structured, large TIV schedules. But in the SME space, the ability to respond quickly and given the size of the risk, we're seeing rates hold up quite well.
I suppose it's one of the attractions of SME businesses that on the whole, over the cycle, it should be less volatile. It wouldn't go up so much in a hard market and wouldn't go down so much in a softer market either.
That's definitely the case. Lower volatility, more consistency with SME, but also harder to access. If you're a capacity player, I mean, Kean and I could have set up in Bermuda and waited for the large accounts to come, and certainly they would come, but there's no real barriers to entry. I mean, it's capital, which is readily available, and broker relationships. But to move down market and to be effective in small business, it's all the stuff we talked about being able to respond rapidly, issue policies at binding, provide good service. Those are elements that create a little bit more stickiness in the space. So in the property segment, it is more competitive than it was a year ago, but still very attractive rate relativities. On the casualty side, it's a quite different story, though. Everyone knows about 16 and 19 as certainly years where the industry suffered. COVID, for some, I think created a bit of a false positive because the courts were closed. And if you weren't lagging your LDFs properly, you probably got a little bit too optimistic about your results. So 21, 22, and 23 are also showing to be challenged. And then, of course, there's just segments of casualty that just perform worse than others. But in the whole, there still is enough markets correcting their casualty books of business today that there is, I'd say in pockets, dislocation still in the casualty space and ample runway. We see an attractive rate acceleration in casualty over the next 3 to 4 years is something that we can lean into with no legacy reserves, good underwriting talent, and be able to position ourselves really well in the casualty market.
No one's ever actually fully bullish about casualty, but you sound confident and you sound happy in the rate that we are getting in 2025 for 2025's risk.
Yes. I mean, again, to your point, casualty has a whole bunch of unknowns in it. But again, playing in smaller accounts, freedom of rate and form, lower limits equals lower volatility, and then being really laser focused on staying away from the real problem areas is, I think, a recipe for success in casualty. And you can make a good return in casualty with the right team.
What about the LA wildfires? It's such a big event to suddenly throw in. I'm so used to looking at Q3 and Q4 as being the cat quarters. And I'm not used to looking at too many things that have happened in Q1, but not a $40 to $50 billion event. How's that affecting the dynamics of the market? It seems at the moment that the market's kind of quietly shrugging it off, certainly from most of the people I've spoken to.
Yeah, I think with respect to pricing, the effect is largely localized to California. We're not seeing evidence right now of a broad price movement across the US market. Now, you have to remember, it's predominantly a personal lines industry event and to a degree a species loss. I think what it's done more so than anything else is reemphasize the need to manage concentration risk. And we'd expect a more acute industry effort on both pricing for wildfire risk, but also the tools for measuring risk at the location level. So in terms of the insurance space, what's the hazard at the particular location we're looking at? Brush setback, construction. I do think that urban conflagration has now come back into the everyday lexicon in terms of how people are thinking about risk. And so I think there's going to be a continued pressure and emphasis on a need to incorporate the ability to manage risk and pricing in a changing landscape too. Year-over-year changes in climate and environment can dramatically change risk profiles with respect to wildfire more so than some other perils. So that's the conversations that we're participating in. But I'd say in general, it's a really challenging peril to underwrite. And I think people are aware of that, but we're not seeing really an acute or dramatic impact in pricing today from the California wildfire.
Again, that's going to hold up submission flow as some of that California business has to come out of the state to look for cover.
No question. I think California is probably the poster child for that pivot from admitted into E&S.
Absolutely. And I suppose, and obviously you guys being a clean, new, no legacy company, obviously you've got those opportunities, but at the same time also you've got the opportunities to build your underwriting systems, particularly in property, with all those new accumulations in mind. And obviously in a way that your reinsurers can look right through as well. And you can all be happy that you know exactly what aggregations you are putting on your books.
I mean, that's been our message to our reinsurance partners in this process, that we're taking a very deliberate, careful and focused effort in terms of managing concentration risk, managing portfolio risk, ensuring high quality data flowing through to them. They're a critical part of our overall capital structure. And we've been really pleased with the partnerships we've been able to develop in just a short period of time. So that message resonates well. I just got back from Bermuda last week and spent a lot of time talking to our existing and potential reinsurance partners. And we do take a very deliberate and careful approach with respect to wildfire, but really at all perils. We're looking to build a long-term, sustainably profitable business. And so while we think the market opportunity is profound, we want to do it in a really judicious and measured way.
Obviously, at the moment, you're a US-only company, and the USA is half of all global insurance premiums. So the opportunity there is vast. So one presumes that you've got your work cut out just to enter that market and properly start servicing that market. But long-term, would you have any ambitions in your next plan, the next 5-year plan, sort of when you get to year 6, year 7, up towards year 10? Obviously, this is the sort of thing that you've been a part of, Kean, back at Validus, back in those days when you accessed the Lloyd's market. And that was a very successful acquisition by all accounts. Do you think you would have any long-term ambitions, or would you say, well, actually, we're not focused on that, of course, but in the long term, might it be an aspiration?
You know, our focus right now is just on the domestic market. And you're right, it's very sizable and growing and offers very appealing returns. And I think one of the dangers for any company is to get mission creep and to do too many things at once. And we've already got a lot to do to execute effectively on our plan. Both Michael and I have global backgrounds, so should that opportunity present itself and it be an appropriate shift in strategy at some point in time, we feel comfortable in our ability to do that, but it's definitely not front of mind for us today.
One thing I would just add, our job right now, like Kean just said, is to just be laser focused on execution. But if we build great systems with great talent, we think of ourselves as also another form of distribution access. And so one of the things we would covet over time is to access the London market to help bring more thoughtful capacity on a syndicated basis. We think we can provide content and distribution access coupled with a risk-taking balance sheet, so we're equally aligned. We think there's some strategic impetus in the medium term to access London to help facilitate expansion into these segments. And that's certainly on our mind.
There are so many more new and interesting different channels with things like London Bridge and other things. So many different ways of doing it that there is probably a channel that suits everybody in different ways. And certainly you've got a much more pliant London market in that sense that there's a lot more smart following capital, that kind of capital that is happy to back people like you who obviously got the track record and the expertise and the access to that business that we know that they would like to have access to as well.
I hope so. Yeah.
It's a competitive market out there. It always has been, and it always will be for the people in this business. The other thing you have with being legacy free on the tech, legacy free on liabilities and finance, you're legacy free on culture as well. So you get another blank sheet of paper to say, well, if I was called in to construct the ideal insurance company, what kind of culture would it have? And so what's the kind of culture you're trying to build? Because obviously you're out there in the market trying to attract the best underwriters to come and work for you.
You know, to have a true underwriting culture, and this is an area where we talked earlier that Kean and I have different backgrounds, but the one thing that we are violently aligned on is culture and underwriting culture. So again, it starts with people who check their egos at the door, that believe that 2 eyes are better than one. So collaboration is key. And the integrated model is equally as key. Sometimes you see as insurance carriers grow and evolve, they get very siloed. Finance doesn't talk to actuarial. Actuarial doesn't talk to the business. Certainly the way we think about it is IT, operations, underwriting, actuarial, finance, distribution, legal, all equally aligned on the direction we're headed, and all are equal stakeholders in the success of the business. So to me, the integrated model is the secret sauce. And the companies I've worked for in the past that profess that integrated model have had the most success.
in terms of checking your ears at the door, I suppose we've all worked in our careers with people who are very good at what they do, but they're not always very good at sharing how they got so good at what they do.
I think that's where we spend most of our time. So each person we've hired, and I think it's important to emphasize, they come from everywhere. It's not like a team lift out of any one place. We don't want to create countercultures inside of Dellwood. So there is a Dellwood culture, and everyone that comes, the key emphasis through the interview process really is about, will this be a good addition to our team? Emphasis on team as we build it out.
What about your own aspirations as entrepreneurs? Obviously, it's very entrepreneurial to do what you've done, and obviously it's very hard. So congratulations on getting this far. As you look to build that business, do you have a goal? I mean, some people have the kind of goal of wanting to have something with not necessarily their name above the door, but to make that Dellwood name a household name and something they could pass on to their children and grandchildren type thing and be proud of and say, right, I built that. And others are slightly different. They have a goal. They like to make things work. They like to say, I've got a really good idea. I want to make this work. And then after they've made it work, they may move on to another new exciting idea. What kind of personalities within that sort of spectrum of entrepreneurialism are you?
I'll take a crack at this one. Probably should hear from both of us on this one, Mark. When we launched Dellwood, it was very much about building something long-term and sustainable. And that aligns with the capital structure we've been able to attract. It's patient, it's informed capital. I think Michael and I are blessed to have been successful in the early parts of our career. I look at Dellwood as the last great venture for me. It's something that we want to focus on culture. We want to focus on profitability. We want it to be a leader in the marketplace. What that ultimately translates to in terms of going to descendants, I do have 4 kids, and at some point they'll be working, and I would be thrilled if they were able to work with me, but that's not a specific goal that we set out. But I think we're really here for the long run and trying to build something that's terrific, that services the needs of our capital partners, that services the needs of our customers, and that is highly aligned with the needs of our distribution partners. And that's really kind of what gets us out of bed every day.
Yeah, and I would concur. You're building a business that demonstrates sustainable underwriting profits centered around great people will be attractive, whether that's ultimately to a suitor down the road or to the public markets. We're building the company with great controls to be public company ready, but we have no timetable. And I think that's also part of the underwriting culture and the selection of our capital base, which is long-term patient capital. So really, ultimately, we don't get that far ahead of ourselves. We want to build a really good franchise and have that franchise continue to perpetuate sustainable profits. And that should be attractive to many over time. And so from our perspective, that's sort of all on the come for us. We really just are focused on the first 3 to 4 years of getting something well established and executing well.
Yes, certainly you have gathered a really impressive group of investors there. And yes, they wouldn't strike me as being the sort of getting the 5-year itch or 7-year itch type investors who were on the phone to you. Why haven't you grown yet? Why haven't you done this yet? You've described them as patient capital, and I'd certainly concur. So well done on doing that. I think I've come to the end of my list of questions. So do you think there's anything that we should have spoken about that we haven't before we sign off?
Now, from my perspective, I really appreciate the opportunity to talk to you today and tell a little bit more about the story. It would be good to sort of check in again at some future point and see how we're progressing. So, we have ambitious goals. We're really heads down focused on delivering a great company here, but really appreciate the opportunity.
Thanks very much. Yes, I mean, I think the younger the company, the faster the time goes. So the more regularly we have to check back in on how you're doing, because I'm sure you'll be twice the size next time I talk to you. So I really appreciate you coming on the show. Obviously, you must be incredibly busy because these things they look wonderful on paper, but yeah, that is a huge amount of work. Just being licensed in 50 states just sort of makes my head slightly explode. So I think that's wonderful of you, and I wish you all the best in your endeavors, and it sounds really great. So we'll check in. We'll be speaking soon, I hope.
Thanks, Mark.
Yeah, thanks, Mark. Appreciate you having us. Love this platform and what you're doing with the podcast.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.